vTalkInsight, Market Drivers Daily for January 27th, 2026. A record-breaking gold price, escalating political frictions, and surging AI capital flows are colliding at the same time, reshaping how risk is being priced across assets. Let's unpack what is really driving markets today and what investors are watching next. Geopolitical risk is shifting from short, sharp tariff shocks toward a slower, more structural fragmentation of the global system, and that matters for risk premia across assets. Over the past few days, we have talked about rising defense budgets and alliance frictions. Today, the story extends further into internal instability in China, rising trade threats in North America, and a clear push by Europe and others to diversify strategic relationships. In China, the unprecedented purge of top military leadership has reduced the Central Military Commission to just 2 members, and the top general is reportedly under investigation for leaking nuclear secrets to the U.S. This leadership vacuum raises questions about internal stability and increases the risk of unpredictable moves on issues like Taiwan, while also complicating assessment of Beijing's stance in the broader U.S.-China relationship. For markets, that uncertainty can support higher risk premia on China exposure, defense supply chains, and strategic commodities linked to potential conflict scenarios. At the same time, U.S. relations with key allies are under visible stress. Threats of 100% tariffs on Canadian exports, warnings over a potential Canada-China trade deal, and sharp rhetoric on NATO have all added to a perception of policy unpredictability, even if some see these moves as negotiating tactics. Volkswagen reconsidering plans for a U.S. Audi plant on tariff concerns, stalled implementation of the EU-U.S. trade deal, and anti-American consumer boycotts in parts of Europe all point to tangible economic fallout through lower foreign direct investment and softer demand for U.S. brands. Europe and other mid-sized powers appear to be hedging their bets. European capitals are working to diversify trade and diplomatic ties away from over-reliance on either Washington or Beijing, while Canada prepares a high-level visit to India focused on trade and energy. U.S.-European negotiations over Arctic security have shifted into multilateral NATO channels, which reduces some tail risk of unilateral action but leaves underlying alliance tensions unresolved. Layered on top are weather-related disruptions and military tensions in the Middle East that are pushing up energy and metals prices, while OPEC Plus is expected to hold production steady, reinforcing the sense of a more politicized, less predictable commodity landscape. These political frictions are feeding directly into the real economy. European defense and energy stocks are outperforming amid broader equity weakness, consistent with a rotation towards sectors seen as beneficiaries of elevated geopolitical risk and higher defense and energy spending. Airbus management has warned that this year will be challenging because of geopolitical risks, and there are early signs of softer transatlantic travel demand as some European consumers hesitate to visit the U.S. Overall, the direction of travel still points toward higher structural risk premia, more fragmented trade, and heavier demand for hedges, which sets the stage for the safe haven dynamics we see in gold, bonds, and currencies. Safe haven demand is expressing itself most dramatically in gold, which has broken through the 5,000 level and delivered its biggest weekly gain since 2020, with a move of nearly 9%. Year-to-date, prices are up close to 80%, and miners from Newmont to Barrick, along with regional materials and gold-focused indices, have rallied to record or multi-year highs. This is happening even as traditional equity volatility remains relatively subdued, underscoring how concentrated the risk-hedging impulse has become. Several forces are behind this surge. Persistent geopolitical tensions, from the Middle East to U.S.-China frictions, concerns about a potential partial U.S. government shutdown, and escalating tariff threats against Canada are all adding to a risk-off tone. At the same time, central banks, including Poland and China, are adding to gold reserves largely regardless of price, reflecting worries about fiscal imbalances, debt sustainability, and longer-run currency debasement. With traditional bond equity diversification weakened in the post-COVID period, some asset owners are revisiting higher structural allocations to precious metals as a portfolio hedge. The flight to safety is not confined to gold. Silver and industrial metals like copper are rallying alongside, supported by geopolitical risks, infrastructure spending, and the so-called debasement trade, suggesting a broader bullish tilt toward the commodity complex. In sovereign debt, U.S. 10-year Treasury yields are holding near 4.2%, and overseas holdings of Treasuries are at record highs, reinforcing their role as the deepest, most liquid haven despite political noise. UK gilts are seen as more resilient to external shocks than the past, while the Japanese yen and Swiss franc have strengthened as investors weigh the risk of FX intervention and seek currency shelters. That said, there's growing unease about how far and how fast gold has moved. Realized and implied volatility in gold have pushed above 26. Options markets are signaling risk of a pullback toward 4,700, and technical indicators like relative strength are flagging overbought conditions. Some participants question whether the gold and silver rallies are sustainable, warning the sharp volatility spike or liquidity event could force investors to sell precious metals, turning what is meant to be a hedge into a source of drawdown. Putting this together, markets appear to be caught between a powerful structural bid for hedges and a growing fear of chasing late-stage momentum. Investors are watching the U.S. shutdown timeline, developments in trade tensions with Canada and China, and Bank of Japan data for clues on potential FX intervention, all of which could shift flows between gold, treasuries, and haven currencies. The key question for multi-asset portfolios is how resilient existing hedging mixes prove if we move from a slow-burn political grind to a genuine shock, especially now that AI-driven growth and capital expenditure are creating new macro dynamics of their own. AI remains a central macro engine, but the narrative is becoming more nuanced as leadership fragments and questions about valuations and real-world productivity build. In recent days, we highlighted massive data center and chip spending as key supports for growth. Today, that story continues with fresh capital flows into AI infrastructure, while at the same time investors scrutinize whether earnings and cash flows are keeping pace with expectations. This is a pivotal week for earnings, with major U.S. tech, European banks, and luxury brands under the microscope, and particular focus on how software and cloud names are navigating AI competition. The U.S. tech sector is no longer a single, monolithic trade. Cloud segments at Microsoft and Alphabet posted roughly 40 and 35% growth last quarter, largely driven by AI-related capital expenditure, and investors appear more confident in their AI roadmaps than in those of Meta or Apple. In contrast, application layer software firms such as Salesforce and Adobe are facing margin compression and competitive pressure from AI-native challengers, which has weighed on share prices. On the infrastructure side, capital is still pouring in. NVIDIA is investing an additional $2 billion in CoreWeave, including early deployment of its CPUs as standalone products, reinforcing conviction around data center growth and putting competitive pressure on AMD and Intel. The deal sparked about a 9% jump in CoreWeave shares and underscores a strong enthusiasm for AI infrastructure. But some observers worry about circular financing dynamics and what that means for the durability of current valuations. Meanwhile, major Chinese tech firms like Alibaba and ByteDance have received approval to order more than 200,000 NVIDIA chips each, highlighting how AI demand is intersecting with supply chain and geopolitical considerations. Beyond chips and cloud, AI is beginning to reshape enterprise workflows and labor markets, though the productivity story is uneven. Synthesia just raised $200 million at a $4 billion valuation to expand from passive AI video into interactive, agent-driven tools that could automate training, candidate screening, and customer support. Large enterprises are under pressure to invest in workforce upskilling so that employees can work effectively with these tools. Yet so far, many see meaningful productivity gains mainly in coding rather than across the broader economy. A Morgan Stanley study finds the UK already experiencing about an 8% net job loss from AI adoption, raising concerns that AI-driven growth could widen the gap between GDP and employment and potentially encourage central banks to tolerate hotter economies, with implications for inflation and demand for hedges. Regulators are also stepping up scrutiny of AI-generated video because of misuse risks, prompting firms like Synthesia to emphasize security and compliance, especially for regulated clients. Despite these concerns, sentiment around AI remains overwhelmingly positive at major global forums, with a broad consensus that the technology can deliver transformative productivity gains and long-term societal benefits. Underlying U.S. economic fundamentals look solid, and there is growing expectation of broader market leadership beyond a handful of mega-cap names, supported in part by optimism around AI and by sectors positioned for AI-related power demand and healthcare deal activity. The counterview stresses that current adoption has not yet delivered commensurate productivity improvements outside a few niches, that parts of the AI value chain may be priced for perfection, and that circular financing could amplify downside if enthusiasm fades. From here, investors are focused on this earnings season for concrete evidence that AI spending is translating into sustainable revenue and margin expansion, on signals about future cloud and chip capital expenditure, and on the regulatory trajectory for AI video and data use. How those pieces evolve will help determine whether AI continues to offset geopolitical and policy headwinds, or instead becomes another source of volatility in the macro mix. Across markets today, geopolitical tension is feeding a powerful flight to safety, while AI continues to channel capital and reshape growth expectations, albeit with rising questions about valuations and real-world productivity. Gold, sovereign bonds, and haven currencies are signaling persistent demand for protection, even as AI infrastructure and cloud earnings drive selective risk-taking and sector dispersion. Watching how policy shocks, trade frictions, and this earnings season interact with safe haven flows and AI capex will be critical for understanding the next phase of this regime. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.